Well, if recent months are any guide, banks and other finance houses will be quick to pass on the Reserve Bank's rate rises. And while the mortgage market is the focus of attention, the real battle could also be for customers' savings. And the disparity between the best and worst in this area is becoming alarming. Sally Tindall is a research director with RateCity and joins us now from our CBD studio. Sally, always good to chat to you on these days. Already there's been some movement with the banks, hasn't there?
Oh, sure has, Ross. NAB, straight out of the gates, they have announced that it will be passing on the full 0.25% hike to its variable mortgage customers. That's to be expected, and we are expecting the other three, that's CBA, Westpac and ANZ, to follow suit, pass it on to their variable customers as well. But disappointingly, yet again, NAB did not say what they're doing for savers. I think their strategy at this point is to take a seat back, look at what everyone else does and see how little they can get away with.
OK, so let's have a look at this here, because we've got a graphic here showing that on $1 million loan, say, for example, the increase of 0.25% is $149. But the reality is that the total rate rises now basically equate to around $1,500 a month. So, you know, it doesn't take too much maths to work out on $1 million mortgage. You're talking the best part of $18,000 after tax per year. This is, of course, the Reserve Bank strategy. It's got to bite at some stage, and that money's got to come from somewhere.
Oh, and when will it bite? We just don't know. Retail sales, 0.6% up in the last set of data. Yes, when you take into account inflation, the fact that the cost of things is higher, it's probably around zero, but that's still too high. We need people to stop spending at the shops. Not easy to do when we're about to go into the silly season with Christmas and summer holidays and things like that. But at one point, and it might be a point soon, it will start biting more households. We will see a drop back in things like retail sales, and hopefully, we'll start to see inflation drop down. But of course, the RBA today increased their forecast for inflation. They're now expecting it to hit 8% by the end of the year. That's up from 7.75%. That's not good news.
No, OK, so just one thing. If I'm negotiating now on mortgages in particular, we'll start there, we'll go to savings in a moment. But the reality is, could I find that 0.25% between the cheapest and the most expensive home mortgage businesses out there today?
Oh, Ross, you can find a lot more than 0.25%. You could find 0.25% easily within your own bank. Find out what your rate is now. See what your bank is offering new customers. In many cases, you'll find it's well over 0.25% less. But then shop around to see what other banks and lenders are offering. It's the smaller banks at the moment that are offering the sharpest rates on our database. We expect a good rate, a cracking rate for an owner-occupier, to be still significantly below 4.5% once this rate hike filters through. But yet the average existing owner-occupier who hasn't haggled for a few months or so, they are likely to be paying a rate of 5.6%. That's, you can get a full percent, potentially more, off your rate by refinancing.
OK, then flip it, because my understanding is that it's the savings that they're all chasing now, because obviously that gives them cheap sources of capital. The big banks don't seem to be passing it on, but some others now are. And the disparity between the big banks and emerging players is quite remarkable in this area.
Well, the big banks have passed on some hikes, but they still picking and choosing exactly which customers get it. You know which customers get it? The ones that shop around and the ones that open up a new account and get an introductory rate. So those poor savers that have got an online savings account with one of the big four banks, I'm talking about CBA's NetBank Saver, Westpac's eSaver, NAB's iSaver, ANZ's Online Saver. They are getting ongoing rates of 1.1% or less. In the case of ANZ, it's 0.6%. I mean, that is ludicrous. The cash rate is now 2.85%. Savings rates should be significantly higher than that. And then when you look at the other end of the scale, you've got ING leading the way. They've got an ongoing rate of 4.05%. Yes, you have to jump through a whole lot of hoops to get that rate, but you can get it on an ongoing basis. And that rate could move to 4.3% once this latest hike filters through. Look at that.
Great stuff. Indeed, Sally, it is a genuine difference. Thank you so much for the information today.